months ago, I made a video about Paycom software when it was trading at about $292, and at that time I said it's not a buy. But now it's trading at about $185, so I want to reevaluate. At $185 of stock price, the market cap is about $11 billion. The PE ratio is about 32, which is not too expensive for a growth company. And the dividend yield is about 0.81%, which is decent. Normally, I cover the business model and financials before I move on to the valuation. Since I already did the video 3 months ago, I'm not going to repeat most of the information. Please watch that video if you want to know more details about Paycom. But in this video, I'm going to focus more on the valuation. Let's first look at why the stock is down significantly from $292 to about $180. The main reason is shown on the screen. 3 months ago, they predicted 25% year-over-year growth and said they can make about $1.715 billion of revenue in 2023. But in the most recent quarter, they cut that guidance from 25% year-over-year to 22% year-over-year to make about $1.679 billion. So because they reduced their guidance from 25% year-over-year to 22% year-over-year, the stock has fallen significantly. Before I move on to the valuation, I want to show this slide to tell you that they are already profitable on a GAAP basis, and they already have close to $484 million of cash and cash equivalents. They also do buybacks, but they are not too significant compared to their number of outstanding shares. Now let's move on to the valuation. If I show you a snip of what I have shown in the past when the stock was trading at $292, I have assumed 20% year-over-year growth for the next 5 years. And I assumed 20% net profit margin and a 30 multiple to come up with $441 stock price. At that time, since the stock price was already at $292, I only had a gain of 51%. And I said 51% in 5 years is not too compelling for the kind of risk we are taking with Paycom. So I said no at that time. So now let me show you a revised valuation based on more conservative assumptions. As you can see on the screen, I modified the 2023 revenue to what they have guided recently. That's $1.68 billion. I reduced my estimated growth rate for the next 5 years. It used to be 20%. Now I changed it to 15%. I think they can do better than this, but I want to be a bit more conservative. And I'm keeping the 20% net profit margin the same because they have been achieving that consistently. And I reduced the multiple from 30 to 27.5. I'm sure people will pay a much higher multiple than this if they can grow 15% year over year for the next 5 years and maintain 20% net profit margin. But I am being conservative. So with that, the stock price would be about $320 in 2028. Currently they're at $185, right? So that's about 73% gain in 5 years with some conservative assumptions. And 73% gain in 5 years will definitely beat the index. So in my opinion, $185 is a buy price for Paycom. And if bought at $185, I'm very confident that I can beat the index. Having said that, I personally am not buying this stock because I already have significant exposure to finance space. For example, as you all are aware, I own JP Morgan, Bank of America, US Bank, SoFi, Nubank, PayPal, Block, right? So I already have significant exposure to this sector. That's the only reason I'm not buying this stock. But otherwise, $185 for Paycom is a good deal and it's going to beat the index. Let me know your thoughts in the comments. Thank you so much for watching.